Wall Street can't stop talking about one stock right now. But while everyone's chasing that one name, there are three other companies sitting at a discount, with stronger numbers and a clearer path higher. I'm Alex Carter. Welcome back to Wealth Signal. If you're only looking at the company everyone's talking about, you could be missing the bigger trade completely. Today I'm walking you through a breakdown from Allomemetry Research. They use something called uniform accounting, a way of reading a company's real numbers instead of the reported ones Wall Street usually quotes. If you're serious about understanding how to read a stock the right way, hit that subscribe button. This is exactly the kind of breakdown we do every week. Today we're covering 5 companies. 3, the numbers say, are worth a closer look. 2, the numbers say to stay away from, and one of them might surprise you. Before we get to the list, we need to talk about the stock everyone's obsessed with right now, SpaceX. Not as a buy, just as the backdrop for everything else on this list. On a uniform accounting basis, SpaceX is actually profitable right now, even with everything it's pouring into AI. The core rocket launch business runs at about a 12% return on assets, which is solid for a business this asset-heavy, because the technology behind what they do is genuinely hard to copy. Then there's Starlink, what the company calls connectivity. That business is already generating $11 billion in revenue at a 30% return on assets. That's 3 times the corporate average. And then there's xAI, the part of the story that's still losing money today. But 2 deals signed in the last couple of months hint at where it could be headed. A deal worth over $1 billion a month with Anthropic, and another worth hundreds of millions a month with Google. Put it all together, and you get a valuation story that's not as crazy as the headlines make it sound. But here's the thing. Even the analysts behind this research aren't buying SpaceX at today's price. They want more room between the risk and the reward. So let's look at where they are finding that room. Stock 1. ASML. Buy. First up, ASML. If you've never heard of it, here's why it matters more than the names you already know. Think NVIDIA, think Taiwan Semiconductor. ASML is the company that makes the machines those chip makers actually need to build the most advanced chips in the world. Without ASML's equipment, none of it gets made. On a reported basis, the market thinks this company runs at about a 15% return on assets. On a uniform basis, it's closer to 22%, 1.5 times higher than people assume. Their machines are so specialized that a Chinese chipmaker once bought one, took it apart trying to reverse engineer it, and couldn't put it back together. They had to call ASML for help. Now, here's what concerns some investors. The stock trades around $2,000 a share, with a reported PE near 68. That sounds expensive on the surface, but on a uniform basis, that PE drops to somewhere around 40 to 45, and when a company is growing earnings north of 20% a year, that multiple stops looking unreasonable. It's the same logic that applied to Amazon back in 2018, when its reported PE of 90 was actually closer to 30 underneath the surface. The takeaway here? The price tag looks intimidating, but the real earnings tell a different story. This is one analysts see as worth a closer look, not because of hype, but because of what's underneath the reported numbers. If you're finding this kind of breakdown useful, drop a like. It genuinely helps this channel reach more people who need to see it. Stock 2. Northrop Grumman. Now let's shift to a name you'd never expect to show up on a stock market channel, a defense contractor. Northrop Grumman. You're picturing missiles and jets, and you're right. But what most people miss is that more than a quarter of this company's profit comes from space. They build satellites. They've launched rockets. And as the space economy keeps expanding around everything SpaceX is catalyzing, Northrop is positioned to ride that wave from the defense side. On a reported basis, this looks like a company barely clearing its cost of capital, a 5 to 6% return on assets. On a uniform basis, that number is roughly double. Here's the concern. The stock is up only about 5% this year, and it's actually down around 25% over the last 3 months. That's not a chart that screams confidence. The pullback comes from uncertainty around where U.S. defense spending is actually headed. But the areas Northrop is exposed to, space, missiles, naval, are exactly where this administration has said the budget is growing, especially with replenishment needs after recent conflicts. On a uniform P/E basis, this stock trades around 26 times earnings, pricing in roughly 5% growth a year. If defense budgets move the way they're projected to, that bar looks easy to clear. Before we continue, throughout this video, I've been referencing visuals and frameworks designed specifically to make these ideas easier to absorb and remember. I've compiled all of them into a single visual summary file for this video. If you want to download it and keep it as a permanent reference, I've set up a Wealth Signal Telegram channel where the file is waiting for you. And it's not just this video. Every video we've done before has its own file in there, and every new video we release, the summary goes into the channel first. So if you want this file, and you want to be first to get every future one, the link is in the description below. Join the channel, grab the file, and I'll see you in there. 3. GE Vernova. Next up is a name tied to what people in the industry call the Jersey Boys. Giant turbines that can power entire neighborhoods. GE Vernova makes these turbines, and right now they're the bottleneck for the entire AI build-out. Because the limiting factor for AI compute isn't chips anymore, it's electricity. Right now it takes more than 5 years to get one of these turbines made. They're sold out, and the company is doubling production and still can't keep up with demand. That kind of scarcity means pricing power. Margins are still ramping. The company's uniform return on assets started around 5% after it spun off, and it's climbing toward the 20% plus levels established competitors already have. Yes, the stock has already had a strong run, and it pulled back hard on broader market fears before bouncing nearly 20% in a single week. That kind of volatility comes with high-growth names like this. But the backlog isn't going away. The pricing power isn't going away, and the bottleneck isn't getting solved anytime soon. That's the kind of setup analysts are willing to stomach some short-term swings for. Quick question for you. Out of these 3 so far, which one would you actually add to your watch list? Drop it in the comments. I read every single one. Now, let's flip to the part most people are curious about. 2 names the numbers say to stay away from right now. Stock 4. AST SpaceMobile. Avoid. First on the avoid list, AST SpaceMobile. This company is trying to do direct-to-cellular satellite connectivity, basically letting your phone connect to satellites without a dish. The problem is, it's competing directly against Starlink, which already makes money in this space and has a far larger satellite network. Right now, AST SpaceMobile runs at a negative 14% return on assets. It's still in startup mode. And the market is already pricing it at $30 billion, which assumes it captures a huge share of what's estimated to be a $45 billion global opportunity over the next 5 to 10 years. That's not necessarily a short. It's just a business with a lot it still needs to prove, competing against an incumbent that's already profitable. The valuation already assumes the best-case outcome. Stock 5. Tesla. Avoid. And the second name on the avoid list might surprise you. Tesla. To justify today's price, Tesla would need a 50% return on assets, a level higher than Coca-Cola, higher than almost every company on Earth. Its current return on assets is around 6%. The bigger issue is competition. China has more than 100 subsidized EV makers, cheap electricity from coal power, and far lower labor costs. That same dynamic already crushed the global solar industry. Even the robotics story carries the same risk. Car companies like Hyundai, Honda, and Toyota are all chasing the same robot opportunity, And that tends to turn into the same kind of industrial business, a solid one, but not a 50% return on assets business. None of this is a knock on the innovation. It's a question of whether the current price already assumes a level of profitability that almost no company in history has sustained. So here's how this stacks up. The strongest setup on this list is GE Vernova. The bottleneck story is real, and it isn't going away soon. ASML comes second. The moat is about as strong as moats get. Northrop Grumman comes third. Slower growth, but a clear tailwind behind it. Notice what all three buy ideas have in common. Real earnings the market hasn't fully priced in yet. That's the whole game. It's not about chasing the loudest story. It's about finding the gap between what a business actually earns and what the price says it earns. This is a breakdown based on research, not a personal portfolio recommendation. Your situation is different from mine. Always do your own homework before putting money into any of these. If this breakdown helped you see something you didn't before, hit that like button. Subscribe and turn on notifications so you don't miss the next one. And drop a comment telling me which of these 5 you're watching most closely. Next week, we're digging into a completely different sector. And if you want the visual summary file for this video, join the Wealth Signal Telegram channel. Link is in the description. I'm Alex Carter, and I'll see you in the next one.